Hello and welcome to Income Tax Fundamentals Part 2. By the end of this lesson, Parts 1 and 2, you should be able to understand filing status, understand gross income, identify the major adjustments to gross income, identify dependents, describe the meanings of taxable income and tax liability, describe payment of taxes, describe accounting methods, and identify tax reduction techniques. First, let's look at accounting methods. The three most common tax accounting methods are cash, accrual, and hybrid. 99% of all taxpayers, or at least all individual taxpayers, use the cash basis of accounting. Most small businesses who are eligible to use cash basis also elect to use that option. Some small business owners, self-employed people who are filing a Schedule C and reporting that income on their personal returns, may elect to use the accrual basis of accounting, but that's pretty rare. And some small business owners who have inventory elect to use the hybrid basis of accounting. Regardless of the method you choose, though, it's important to think about it and think wisely, choose wisely before you file that first return. Because once you choose a method of accounting and file that first return, you must stick with it. In order to change, you actually have to request permission from the IRS. That requires filing a fairly lengthy form, and the change isn't automatic, so the IRS may not approve that request. So definitely want to make sure that you give it some thought before you file that first income tax return. Next, we'll talk about filing status. Now, we mentioned filing status in the income tax formula in the last lesson. Here you can see the various different filing statuses available to U.S. taxpayers. They include single, dependent of another, head of household, married filing jointly, married filing separately, and surviving spouse. A surviving spouse election is generally available only in the year of a spouse's death. Occasionally, if a surviving spouse has minor dependent children, you can file as a surviving spouse for 2 extra years, up to 2 extra years, but typically surviving spouse is only available in the year of a spouse's death. It's also important to note that your filing status is determined on the last day of the year, and that filing status is effective for the entire year. So if you get married on December 30th, you're considered married for the entire year, not just married for 2 days or a prorated portion of the year. If your divorce is final on December 31st, you're considered either single or head of household for the entire year. Now, head of household filing status means you are unmarried at the end of the year and you also have a qualifying dependent. Qualifying dependents are important for head of household filing status, but they also may be eligible for a child credit or a family credit. We'll talk about these credits in a later week, but here we'll talk about who is a qualifying child and who is a qualifying relative. So first, let's talk about the qualifying child. A qualifying child must meet the relationship test, the abode test, the age test, and the income test. So first, the relationship test. The dependent could be the taxpayer's child, and that could be an adopted child, a stepchild, a foster child. The dependent could be a brother, sister, half-brother, half-sister, stepbrother, sister, or a descendant of either of these parties. But ancestors of these parties and in-laws are not included in the relationship test for dependent child. The dependent child must also live with the taxpayer for more than half the year. That's the abode test. Must either be under the age of 19 or under 24 if a full-time student. That's the age test. And this qualifying child must meet the income test, which means he or she is not providing more than half of his or her support. So that's our qualifying child. We also have a qualifying relative. A qualifying relative must meet the relationship test, the gross income test, and the support test. So a qualifying relative is fairly similar to the qualifying child, although the relationship test is a little bit different. It could be a child that doesn't meet those specific relations that we discussed in the last slide. It also could be one of those ancestors, a parent, a grandparent. Unlike a qualifying child who merely can't provide half of his or her support, a qualifying relative has some pretty restrictions on the amount of income that they can receive. So it's based on a equivalent exemption amount, which is roughly $4,000, a little bit more. It is indexed for inflation. But for an adult to be a dependent of someone else, a qualifying relative, they must earn very little. And of course, they also do need to meet the support test where the taxpayer is providing more than half of that qualifying relative support. Now, qualifying relative is a little bit of a misleading term. Certainly, related adults can qualify as qualifying relatives, but you don't have to be truly related. You don't have to be related by blood, and you don't have to be related by marriage either. So it is possible for unmarried adults to live in the same house, and one could qualify as under the qualifying relative rules as a dependent of another. And when we talk about this qualifying relative, sometimes one of the most common types of qualifying relatives that we see in practice is the qualifying parent. And often a qualifying parent will be supported by several children if they can't support themselves in retirement. Under this scenario, the IRS has given us multiple support agreement rules. So if there is a group of taxpayers, say siblings, who together are providing more than half the support for a parent, then anybody who is providing at least 10% of that qualifying relative support may claim that taxpayer, that parent, as a dependent. Now, only one person in that group can claim the dependency exemption, but at least one person does receive it. So there requires some agreement among the family members on who's claiming that parent or that qualifying relative. But if a group is providing support, someone can get that tax benefit. In addition, there are many, of course, single parent households. Many taxpayers do get divorced, and the IRS has some rules around who can claim children as dependents in the event of divorce. Generally, it's going to be the custodial parent. However, there is an exception. If you would have been entitled to claim the child as a dependent if you'd been married for the entire year, and you don't have to have sole custody, you could have joint custody. If the child is living with that parent, that taxpayer, for the entire year, then generally the parent with whom the child has lived for the entire year will receive that dependency exemption. However, having said that, it is possible in a divorce decree for the divorcing parties to spell out who gets the child dependency credit, exemption, whatever benefits there are to claiming the children. If you are dealing with taxpayers, with clients who are in the middle of negotiating a divorce, it is very important that you advise them to make sure that this is spelled out in the divorce decree. It doesn't have to be, but it makes life much, much easier. Now, both child and relative dependents have a couple of other tests of them they must pass. They cannot file joint returns. So for qualifying children, typically they're not going to be married, although some qualifying children under the age of 24 could potentially be married. They can't file a joint return in order to be claimed as a dependent of someone else. And the qualifying child or the qualifying relative needs to either be a citizen or a resident of the United States. Now let's talk a little bit about kiddie tax. The kiddie tax rules were established to prevent the shifting of income from very high income taxpayers to their lower income dependent children, especially younger dependent children. The kiddie tax applies to unearned income above an index threshold for any child under age 19 or under 24 for full-time students when either parent is alive during the year. Note this kiddie tax does not apply if the child has earned income that exceeds half of his or her support, if the child is married and filing a joint return, or if both parents are deceased. This creates an interesting planning opportunity because dependent children under 24 who are students may or may not be working and providing more than half of their support for tuition and fees and living expenses. So there may be some planning opportunities for children in college. Net unearned income is subject to kiddie tax, generally computed as the value of unearned income less 2 times a minimum standard deduction. Gross income between the first and second standard deduction amount is taxed at the child's rate. Taxable income above double that standard deduction figure is taxed at trust rates, which are generally higher than individual income tax rates. Regardless of the age of the child, earned income such as commissions and wages are taxed at the child's rate, not at trust rates, and that's very important to keep in mind. To avoid or at least minimize kiddie tax, assets held by children 19 or under, if a student, should be invested in more growth-oriented assets and less income-producing assets to the extent this aligns with financial planning goals. And of course, this applies to taxable accounts only, not to tax-deferred 529 plan or Coverdale accounts, which are more popular now than they used to be. So you may not see as many dependent children with custodial accounts as maybe we saw 10 or 20 years ago, but you will see them from time to time, so it's important to be familiar with these kiddie tax rules. Next, let's talk about filing requirements. Generally, a calendar year taxpayer, calendar year individual, has a filing due date of April 15th of the year following the close of a tax year. Now, I mentioned there are very rare cases where an individual may have a fiscal year end, and when that happens, the due date for that individual is the 15th day of the 4th month following the close of the tax year. It is also possible to request an automatic extension, that's 6 months, and so for those calendar year taxpayers, an April 15th due date becomes an October 15th due date. It's also important to note that when the 15th of the month falls on a weekend or a holiday, the due date becomes the next business day. So for instance, April 15th for the last couple of years has fallen on a weekend. When April 15th falls on a Saturday, the due date is, believe it or not, the 18th, which is a Tuesday. That's because we don't count Saturday the 15th, we don't count Sunday the 16th, and Monday the 17th is a holiday in certain states, certain service centers, and therefore it's called Patriots Day. Therefore, everyone in the country gets an extra day to file their tax returns. This is true not just for the filing date for the tax return itself, but for any due date, estimated tax payments, any other due date that there is. If that falls on a weekend or a holiday, you look to the next business day. Now, the last concept we're going to talk about is FICA. FICA is short for Federal Insurance Contribution Act, and it's composed of 2 separate taxes, Social Security and Medicare tax. I think we're all familiar with the idea that Social Security tax is not applied to all earned income. It is only applied to a wage base, which is indexed for inflation each year. But in contrast, the Medicare tax is assessed on all earned income, and that could be W-2 wages or it could be self-employed income. So Social Security and Medicare tax, FICA, those taxes have been around for a long time, but the Medicare surtax was added less than 10 years ago, and it involves an extra 0.9% tax on unearned income over a threshold amount and 3.8% additional tax on unearned income over certain thresholds. Now, those thresholds amounts are $200,000 for a single person and $250,000 for a married couple. And those numbers are not indexed for inflation. So as time goes on, more and more people will be subject to these surtaxes since Congress has not decided to adjust these numbers for inflation. It's also important to note that for the unearned income surtax, there's another test in addition to the amount over the applicable amount, either $200,000 or $250,000. There's also a net unearned income test test. So it's the less of the amount of your total taxable income or your AGI over $200,000 or $250,000 or your net unearned income. So what is the difference between FICA and self-employment tax? I've been using them kind of interchangeably. FICA, of course, is the tax that an employer pays. An employee also pays half of that tax, and if you've had a W-2 job, you've seen that come out of your paycheck. Self-employment tax is the way that a self-employed person pays both the employer and the employee portion of taxes. It is assessed in addition to income tax. And so when you have clients who become self-employed for the first time, if they haven't had proper tax planning or tax counseling, they're often very unpleasantly surprised at their tax liability. Perhaps they didn't earn that much as a self-employed person in the first year. That's not unusual when you start a business. Quite often it takes time to build a client base. You have expenses in the first year that you don't typically have later on. So clients won't be earning as much as they would in later years, and perhaps not as much as they earned as W-2 employees. And if they're only in the 15% income tax bracket, or now the 12% tax bracket, they would see their taxes potentially more than double with the self-employment tax, which is 15.3%. So if you have clients who are thinking about becoming self-employed, it's important that you counsel them about self-employment tax, or if you're not comfortable giving them that tax advice, make sure that they consult a CPA or a tax advisor who can help them plan properly and factor that expense into their budget for business taxes. So to summarize, what we've done today is talk about the income tax formula, the concepts of gross income and excluded income. We've talked about accounting method, filing status, and personal and dependency exemptions. And we've talked about kiddie tax and self-employment.